Hello, I'm Ekaterina from Wolfline Capital, and today I'm going to discuss the financial crisis. Banking collapse on both sides of the Atlantic, central banks' emergency funding to banks to maintain liquidity, forced purchases of SVB, Credit Suisse, First Republic Bank, and more. Seems we saw all this before 15 years ago. Is this a repetition of the 2008 financial crisis? Let us have a look. At the heart of the 2008 crisis was a major Wall Street bubble that was built on expansive spread of complex, non-transparent securities ultimately backed by bad loans. Home subprime mortgages were pervasively given out by mortgage providers without properly checking clients' creditworthiness. Banks and financial institutions were heavily involved in proprietary trading. They bundled cash flows from mortgage loans into mortgage pools, issued mortgage-backed securities or collateralized debt securities, and sold these securities to investors. These securities did not have a transparent market price as a reference. Moody's and Standard & Poor's did not subject the issuers to due scrutiny and put A ratings on these securities as if they were treasury bonds. The subprime fever originated in the United States, but soon spread to European banks like Deutsche Bank, HSBC, and Credit Suisse. By 2008, close to 30% of all high-risk U.S. mortgage securities were held by foreign investors. The mortgage bundles grew in number to an overwhelming degree, with a large percentage of subprime mortgages defaulting and resulting in a disastrous bubble burst. In the US, banks were left holding trillions of dollars of worthless investments in subprime mortgages, and stock market plummeted. Between late 2007 and 2009, the crisis wiped out nearly $8 trillion in market value. According to Moody's Analytics, between the second quarter of 2008 and the first quarter of 2009, the Great Recession led to a loss of more than $2 trillion in global economic growth, which is a drop of nearly 4%. In response to the crisis in 2008, the federal government created the Troubled Asset Relief Program, an $800 billion government bailout designed to keep the big troubled banks and corporations afloat. It was the biggest bailout in the U.S. financial markets history since the time of the Great Depression. What are we dealing with now? Is the 2023 crisis really as big and disastrous as the 2008? Some experts believe that this is not a repeat of 2008 because the regulatory oversight has improved since then, and the US big banks became much better capitalized now than they were in 2008. For example, as of the end of March 2023, JP Morgan Chase had a $3.67 trillion in total assets compared with $1.5 trillion in 2007. Indeed, enacted in 2010, the Dodd-Frank Act made reforms in the U.S. financial regulations. It mandated banks with assets above $50 billion to run annual stress tests to ensure that they could withstand a major financial catastrophe. Later in 2018, however, Trump loosened the stress test requirement by raising the asset threshold up to $250 billion. The Dodd-Frank Act created an Office of Credit Ratings at the Securities and Exchange Commission to regulate credit rating agencies like Moody's and Standard & Poor's. It restricted banks from engaging in proprietary trading or from using their depositors' funds to invest in risky investment instruments such as hedge funds or private equity funds. Some experts also voice an opinion that the current banking turmoil is not as potentially severe as the 2008 because its cause is not as much impaired loans, but rather banks' paper losses on made loans and purchased long-term bonds because of the Fed's rapid tightening. But does the rise in interest rates of 22-23 lead to a smaller financial crisis than the mortgage crisis of 2008? Rising interest rates are a double-edged sword for banks. On the one hand, higher rates improve loan income. On the other, they raise cost of liabilities and reduce the value of investment securities held as assets. The net effect of mismatch between banks' assets and short-term deposits can still be an erosion of a bank's solvency. A research has come out by the U.S. National Bureau of Economic Research that shows that the market value of the U.S. bank assets is actually $2 trillion lower than the book value. Banks are holding a large amount of $2 trillion in unrealized losses. This may not be a problem unless customers pool their deposits. Then the banks would have to sell their assets at a loss. The research shows that after 2008, when large banks were hit with tighter regulations, small banks, which are the engine of credit growth to private economy, took on more risky lending, which included office buildings and retail stores. The small bank's loan-to-deposit ratio is much higher at small banks compared to large ones. The assets of small banks have been permanently impaired by the interest rates rise, but the banking sector has not realized that yet. If a large bank faces deposit outflows, it can take a loan from the Fed through an emergency window, backing it with a portfolio of securities. It is an expensive loan, but these big banks will have liquidity. If a small bank faces a deposit outflow, it does not have a lot of securities, so it may be forced to sell a part of the loan and securities portfolio at a loss. Also, as IMF recently warned, another global financial crisis might be currently brewing in the rapidly growing alternative finance industry, which include a wide range of firms, insurers, pension funds, mutual funds, or high-risk hedge funds. Moreover, the strife in the U.S. Congress over the debt ceiling may add to complexity and risk in already turbulent financial situation. In the United States, the debt ceiling is the limit on how much national debt Congress lets the Treasury Department incur. The Republicans insist that Biden cuts his $6.8 trillion budget, or they won't approve raising the debt ceiling, which is now at $31 trillion, which could cause a big economic calamity. According to reports from Wells Fargo Bank, if the United States does not raise the debt ceiling, the government will default on its debt starting sometime between early July and early September. In that event, the Treasury would have to either default on payments to bondholders or immediately curtail payments of funds owed to various companies and individuals. This is not a guarantee that the current banking turmoil will sprawl into such a disastrous crisis that happened 15 years ago, but the risk is certainly there. What should always be remembered about the financial crisis is that events often move in fast and unpredictable ways. This was Wolfline Capital review of the causes of 2008 and 2023 financial crises. If you'd like to get in touch, you can find links to our website and social media networks at the end of the video. Thank you and good luck.